In March 2023, as the collapse of Silicon Valley Bank sent shockwaves through the financial system, panic spread across markets. Depositors rushed to withdraw funds. Regulators scrambled to contain contagion. Behind closed doors, emergency calls were made. Among the first people contacted was the CEO of BlackRock. His name is Larry Fink. He was not elected. He does not hold public office. Yet during moments of crisis, the highest levels of government seek his guidance, because he sits at the center of global finance. BlackRock manages approximately $11.5 trillion in assets. That figure alone makes it the largest asset manager in the world. But the deeper layer of power lies elsewhere. It lies inside a system called Aladdin. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. The goal was simple: never be blindsided by hidden risk again. Over decades, Aladdin evolved into the nervous system of modern markets. Roughly 10% of global financial assets flow through systems connected to BlackRock. Information is power, and BlackRock has more of it than anyone else. The firm can see aggregated exposures across industries. It can identify stress points before they erupt. It can model systemic shocks faster than regulators. That informational advantage makes BlackRock indispensable during crises. It also makes it extraordinarily influential in normal times. Yet BlackRock's dominance is not built on secrecy. It is built on index funds. The rise of passive investing changed everything. Instead of trying to beat the market, investors began buying the entire market through low-cost funds. BlackRock's iShares platform became a dominant force in that movement. Trillions of dollars flowed in. But passive investing carries an overlooked consequence. When you buy an index fund, you do not directly own the underlying stocks. The fund owns them. BlackRock votes the shares. Millions of retirement accounts collectively give BlackRock significant voting power. That voting power translates into influence over corporate boards, over executive compensation, over mergers, over strategic direction. BlackRock is often the largest shareholder in major corporations. It owns significant stakes in Apple, in Microsoft, in Amazon, in Tesla, in ExxonMobil, and thousands more. It does not own them outright, but it owns enough to matter. When BlackRock signals support or opposition, boards listen. When Larry Fink writes his annual letter to CEOs, it is studied line by line. Because access to capital depends on alignment. This is not a conspiracy, it is structural influence. Scale creates leverage. Leverage creates dependency. Governments depend on BlackRock's analytical capabilities. Corporations depend on BlackRock's capital. Investors depend on BlackRock's funds. And most individuals are connected to it through pensions or retirement accounts. The result is a system where financial power is centralized, but largely invisible. Fink rarely appears on magazine covers. He does not dominate headlines. He does not campaign for office. Yet his decisions ripple across markets worldwide. This concentration of influence did not emerge overnight. It was built methodically over decades, through technology, through passive investing, through crisis management roles. Through relentless expansion, BlackRock became too integrated to ignore, too large to sideline, too connected to replace. Understanding that structure is critical, because the modern financial system is no longer just banks and governments. It is asset managers, and at the center of that network stands Larry Fink, the man most people have never heard of, the man who influences trillions. The man who helped design the system you live inside every day. This is where the story begins. Larry Fink did not begin with global dominance. He began with failure. In 1986, while working at First Boston, he lost nearly $100 million on a single interest rate bet. The loss was not just financial, it was psychological. He realized something dangerous. The financial instruments he helped create were too complex to properly track. Risk was invisible. That moment changed everything. In 1988, with backing from Blackstone, Fink founded what would become BlackRock. The mission was clear: build the most advanced risk management system in finance. That system became Aladdin. Aladdin allowed institutions to measure exposure across thousands of securities simultaneously. It could simulate market crashes. It could track interest rate sensitivity. It could detect hidden vulnerabilities. No other firm had comparable technology. But technology alone does not create dominance. Scale does. And scale came from passive investing. During the 1990s and early 2000s, a shift occurred in global markets. Investors grew skeptical of expensive active fund managers. Most failed to consistently beat the market. Low-cost index funds began attracting capital at historic rates. BlackRock positioned itself perfectly. Through its iShares platform, it offered simple access to entire markets. Investors loved the lower fees. Institutions loved the efficiency. Money flooded in. Trillions moved from active management into passive index products. And with every dollar that flowed in, BlackRock accumulated shares in nearly every major corporation. Here is the overlooked detail. When you invest in an index fund, you do not vote the underlying shares. The asset manager does. That means BlackRock votes on behalf of millions of investors. This voting authority gives BlackRock structural influence across corporate America. It does not need majority ownership. A 5 to 10% stake in a large corporation is powerful. When combined with similar holdings across competitors, that power multiplies. BlackRock, Vanguard, and State Street collectively form what analysts call the Big Three. Together, they are the largest shareholders in most major public companies. Airlines, banks, energy companies, pharmaceutical firms, technology giants. The same three institutions appear repeatedly at the top of shareholder lists. This creates a phenomenon known as common ownership. Instead of one company dominating an industry, asset managers own pieces of all competitors. This does not require illegal collusion. It subtly reshapes incentives. If your largest shareholders own your rivals, aggressive price wars make less sense. Industry-wide stability becomes preferable. Academic research has linked common ownership to reduced competition in certain sectors. Higher prices, lower innovation pressure, more predictable margins. From the perspective of asset managers, stability is good. Index funds aim to mirror the market, not disrupt it. But stability at scale can also mean concentration. The power is quiet. It rarely makes headlines. Shareholder votes happen thousands of times per year. Board seats are approved. Compensation packages are ratified. Strategic shifts are endorsed. BlackRock's proxy voting guidelines shape these outcomes, and most retail investors never see the ballots cast in their name. This is how influence scales without visibility. It is legal, it is transparent in filings, yet it is rarely discussed in public discourse. BlackRock does not need to command companies directly. Its capital allocation decisions send signals. Support or opposition carries weight. When Larry Fink publishes his annual CEO letter, executives pay attention. Because access to trillions in capital depends on alignment, the rise of passive investing was marketed as democratization, lower fees, broader access, simplicity, all true. But democratization also centralized voting power in the hands of a few asset managers. Millions of dispersed investors became one concentrated voice, and that voice is controlled by firms like BlackRock. The transformation was gradual, no dramatic takeover, no secret meetings, just steady inflows, quarter after quarter, year after year, until the majority of equity ownership in public markets became mediated by index funds. Larry Fink did not conquer industries through hostile acquisitions. He built pipelines for capital. He captured flows. And whoever controls flows eventually shapes outcomes. This was the second stage of the system: risk visibility through Aladdin, ownership scale through passive funds, voting authority through structural design. It was not flashy, it was patient, and it permanently altered the balance of power in global finance. By the late 2010s, Larry Fink was no longer just managing money, he was shaping corporate philosophy. In 2018, his annual letter to CEOs introduced a clear message. Companies must serve a social purpose. Profit alone was no longer enough. This marked the rise of ESG, environmental, social, governance. Under this framework, corporations would be evaluated not only on financial performance, but also on climate impact, diversity metrics, labor standards, and governance structures. On the surface, ESG sounded responsible. Investors increasingly cared about sustainability. Public pressure on corporations was rising, but behind the language of responsibility was a new layer of influence. BlackRock would use its voting power to enforce these standards. If companies failed to align, BlackRock could vote against directors. It could withhold support. It could redirect capital. And when you manage over 10 trillion, capital redirection changes behavior fast. Executives read Fink's letters carefully. Boardrooms adjusted strategy. Energy companies reconsidered long-term investments. Technology firms updated diversity policies. Manufacturers issued sustainability pledges. This was not government regulation. It was private capital discipline. BlackRock's size made ESG enforcement possible. Because the firm was often a top shareholder in most major corporations, its expectations carried weight. Critics argued this was political activism. Supporters called it responsible stewardship. Either way, the influence was undeniable. Capital allocation became a lever for social change. The next expansion of power came through crisis management. During the 2008 financial collapse, the US government needed help valuing toxic assets. Regulators lacked the tools to assess complex mortgage securities, so they turned to BlackRock. Using the Aladdin system, BlackRock evaluated distressed portfolios and advised the Federal Reserve and Treasury. The firm was paid to help stabilize the system. This established a precedent. When markets panic, call BlackRock. The pattern repeated in 2020. As COVID-19 triggered a global financial freeze, the Federal Reserve launched emergency bond buying programs. Once again, BlackRock was selected to manage key facilities. The Fed purchased corporate bond ETFs. Some of those ETFs were issued by BlackRock itself. The arrangement was legal, but it highlighted how deeply integrated BlackRock had become within the financial system. Advisor and market participant, crisis manager and beneficiary, the lines blurred. This is where critics began describing BlackRock as a fourth branch of government. Not officially, not constitutionally, but functionally. When elected officials face systemic risk, they rely on BlackRock's infrastructure. That reliance creates trust. Trust creates influence. Influence creates permanence. No elected leader voted Larry Fink into power, yet his firm plays a central role during emergencies. And because BlackRock manages money for central banks and sovereign funds worldwide, its reach extends far beyond the United States. Another layer of influence lies in common ownership. BlackRock, along with Vanguard and State Street, often appears as a top shareholder across entire industries. Airlines share overlapping major investors. Banks do too. Pharmaceutical giants, energy conglomerates, technology titans. When the same asset managers hold significant stakes in competing firms, incentives shift. Aggressive competition can reduce overall portfolio returns. Stability becomes attractive. This does not require secret coordination. It emerges from structure. Academic research has examined whether common ownership dampens competitive intensity. The debate continues, but the concentration of voting power is clear. Add ESG influence to common ownership. Add crisis advisory roles. Add trillions under management. The result is unprecedented financial centralization. Fink did not seize this authority overnight. It accumulated gradually. Each crisis expanded trust. Each inflow increased scale. Each proxy vote reinforced expectations. Today, BlackRock stands at the intersection of markets and policy. It does not pass laws, but it shapes capital flows. It does not regulate industries, but it influences governance standards. It does not control governments, but governments call when stability is threatened. This is modern financial power, not loud, not theatrical, but embedded, structural, persistent, and deeply woven into the architecture of global capitalism. By this stage, Larry Fink was no longer simply an asset manager. He had become a central node in the system itself. By the mid-2020s, the influence of Larry Fink was no longer just about markets. It was about ownership itself. The global economy began shifting from ownership to access, from buying to subscribing, from holding assets to renting them, and large asset managers were perfectly positioned to benefit. At the center of that shift sits BlackRock. Consider housing. After the 2008 crash, home prices collapsed. Foreclosures flooded the market. Institutional investors stepped in with cash. Private equity firms acquired thousands of single-family homes at deep discounts. Companies like Blackstone expanded aggressively into rental housing. Large neighborhoods were converted into long-term rental portfolios. While BlackRock itself did not directly purchase most single-family homes, it became a major shareholder in companies involved in the rental transformation. It also owns significant stakes in major home builders. That positioning allows it to benefit whether homes are sold or rented. Over time, a new model emerged: build-to-rent communities. Entire subdivisions constructed not for families to purchase, but for institutions to hold as income-producing rental assets. These homes never enter the ownership market. They are born as rentals. For younger generations, this changes the equation. Higher prices, cash offers from institutions, limited inventory, rising interest rates. Home ownership becomes harder to achieve. Renting becomes permanent. Rent flows upward to institutional landlords, and institutional landlords often operate within portfolios managed or influenced by BlackRock. This is not a hidden conspiracy. It is capital efficiency. Institutions can raise billions quickly. They can outbid individuals. They can hold assets indefinitely, and they can convert ownership into predictable income streams. The same logic extends beyond housing. Cars shift toward leasing models. Software becomes subscription-based. Entertainment moves to streaming platforms. Access replaces possession. Subscription revenue is steady, predictable, attractive to large asset managers seeking stable cash flow. Fink has described this evolution as part of modern capitalism, an economy of services, an economy of access. Critics connect it to a broader global narrative popularized by the World Economic Forum. A phrase emerged from a 2016 WEF video: "You will own nothing." Fink did not invent that slogan, but BlackRock's business model aligns with its economic implications: asset concentration, centralized ownership, distributed access. When trillions of dollars concentrate under a few asset managers, structural power follows. Your bank likely has BlackRock as a major shareholder. Your employer probably does too. Your retirement account may flow into BlackRock index funds. The companies that provide your utilities, food, healthcare, and digital services often list BlackRock among their top investors. Avoiding exposure is nearly impossible. This raises a difficult question. Is this system efficient or dangerous? Supporters argue passive investing lowered costs dramatically. Index funds democratized market access. Risk management systems like Aladdin improved financial stability. ESG frameworks encourage long-term thinking. From that perspective, BlackRock represents evolution. Critics see concentration of power without democratic accountability. They worry about common ownership dampening competition. They question private enforcement of ESG standards. They fear regulatory capture during crises. Both interpretations can coexist. The system is neither cartoon villainy nor pure benevolence. It is structural capitalism scaled to unprecedented levels. Larry Fink's real achievement was not domination through aggression, it was integration. BlackRock embedded itself in retirement systems, in central banking, in corporate governance, in global capital flows. Integration creates durability. Durability creates permanence. Fink will eventually step down. Leadership will change, but the machine remains. Passive investing continues expanding. Institutional ownership keeps rising. Financial infrastructure becomes more centralized. The power is no longer personal. It is systemic, and that is what makes it enduring. You may not know the mechanics of index voting. You may never log into Aladdin. You may never attend a shareholder meeting. Yet the decisions made within that framework influence your mortgage rate, your rent, your retirement returns, your cost of healthcare, your exposure to market risk. Understanding that structure changes perspective, because modern finance is no longer just about buying stocks. It is about who controls the flows, who allocates the capital, who votes the shares, who advises governments in crisis. Larry Fink helped design that architecture. BlackRock operates it at scale, and whether you approve or not, you live inside it. The story of Larry Fink is not really about one man. It is about a structure, a financial architecture that quietly reshaped capitalism over 3 decades. Through BlackRock, trillions of dollars flow across markets every single day. Retirement accounts, pension funds, government reserves, corporate treasuries, all connected through index funds and risk systems like Aladdin. This power was not seized. It was accumulated, one inflow at a time, one crisis at a time, one shareholder vote at a time. Passive investing centralized ownership, common ownership reduced competitive pressure, ESG frameworks expanded influence into corporate policy, crisis advisory roles, embedded BlackRock inside government response mechanisms. None of this required conspiracy, it required scale, and scale created leverage. Today, avoiding the system is nearly impossible. Your savings likely pass through index funds. Your employer likely has BlackRock among its top shareholders. Your bank probably does too. The companies you rely on every day are shaped by proxy votes cast on behalf of millions of investors. That is the quiet reality of modern finance. The real question is not whether Larry Fink controls everything. He does not. Markets are vast and complex, but he helped design a structure where asset managers sit at the center of capital allocation, and capital allocation shapes the future. Fink will eventually step aside. Leadership will change, but the infrastructure remains. The machine continues operating, understanding that machine matters. Because once you see how ownership, voting power, and capital flows intersect, you recognize the invisible architecture guiding the economy. You may not control trillions, but you live inside the system that does.